Does your 401k or workplace retirement plan outperform your other investments, outperform your Roth, outperform your IRA? It usually will, and it will be very frustrating. Let me explain why coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so when all investments are going up, when the rising tide lifts all boats, it's, hey, everything's good. My 401k did this, my IRA or my Roth did something similar. Okay, great. When investments are going down, you can scrutinize them more and say, well, wait a second. This one is good and that one is bad. And guys, I see this all the time. I'm just going to take a quick tangent here. One of the most dangerous ways to select investments is to look among a choice of investment options and look at that first column of performance, the 3-month performance, or the next column, the 1 year, and assign that the ones that have done well in either the 3-month or 1 year, say the ones that have done well, those are the good ones. And the ones that have done poorly, as those are the bad ones. And here's why. Because markets and investments move in cycles. They move in cycles, okay? And so what has been a good performer recently may not be a good performer, over the foreseeable future. They ebb and flow. That's why you should have a diversified mix of high quality investments. And you might be scratching your head, well, okay, guru, tell us then, how can you distinguish a good investment from a bad investment? There's a lot of research that goes involved in that. We actually have a 13-point inspection where we look at manager tenure, cost, consistency, risk-adjusted performance versus peer group. All of that kind of infused together to help us figure out what are high quality, good long-term investments. And then we update that analysis every single month to ensure that what we're holding are still fantastic long-term strategies, even in the short term if they've performed poorly, because that's what's happening in the cyclical market. But I digress here. Let's talk about this. When you are looking at different accounts, and specifically between your 401k at work and your Roth IRA or your IRA held somewhere else, either by yourself or with an advisor. What do you do when one of them performs differently than the other? And specifically, why might your 401k tend to outperform your IRA or your Roth? And I mean tend to, like, most of the time. In fact, definitely this year or in down markets. What do you do? Well, that's going to happen a lot. Your 401k most likely is going to outperform your IRA, your Roth IRA, more often than not. And why is that? Because of a very powerful concept called dollar cost averaging. That's right. You are making ongoing contributions into that workplace retirement plan. And even if you say, well, I'm contributing to my IRA and my Roth, most people do that once a year in a big chunk, okay? The key with dollar cost averaging is you're going to invest a certain amount of money consistently over time. So you're going to do that every 2 weeks or every month, however often you get paid. And so let's use, for example, that your percentage contribution into your 401k equates to $500 every single pay period going into your 401k. Well, when the investments are, going up and down, that $500, when the investments are down, you're buying more shares. You're still investing that $500 out of your paycheck, but that $500 can go further because stocks are on sale. It doesn't feel that way, but you're able to buy more shares. Shares are cheaper, okay? They cost less. Versus at a high point, which inevitably will happen a few months later or 6 months later or later that year, whatever, you're able to, that $500 contribution, you're buying fewer shares. And then stocks drop again, because the next month something, another risk appears and your $500 contribution buys more shares, and then vice versa. Over that time, if you average that out, you're able to buy more shares at cheaper prices, and that means on average you're buying in more at lower prices. On average, lower prices, and that's going to make your return look a little rosier in that 401k than compared to your IRA, which is just sitting there. You're not really adding a lot of contributions, or if you are, typically people are doing it just once a year, and therefore not able to get the benefits of that dollar cost averaging. Does that make sense? Now, certainly during this time period, I'll go back to 2020. We had an emergency show of the Wise Money Show, our weekly 1-hour talk show that airs right here on this channel every Saturday morning, 10 a.m. Eastern Time, also on podcast as well, same time, so check that out. But back in March of 2020, I had planned to be discussing something else, and then the bottom fell out, and we said, well, we've got to talk about investments. And I'm gonna tell you, we're sitting in our studio, we're recording live, and everyone's fearful and everything. And I throw the question out there to my co-hosts, Kevin Korhorn, Josh Gregory, guys, what should investors do? And we hadn't talked about this. None of the show is scripted, and this isn't scripted either, by the way. And so what should people do? And the first thing out of Kevin's mouth, as if he hadn't been living in the world for the past 2 months, if he hadn't seen all of the fear and felt the fear, the first thing out of Kevin's mouth is, you should max out your 401k early this year. You should contribute even more, double your contribution right now. That was the first thing out of his mouth. I'm glad the camera wasn't on me, because there was definitely a look of shock on my face. That's the right thing to do unemotionally. That's the right thing to do if you're hardwired as a fantastic investor. The problem is we are very emotional about our own money, and we are hardwired to be bad investors. We don't want to buy more. We don't want to invest more when prices go down. But you should. And in fact, right now, and I don't know when you're listening to this, when I'm recording it, the stock market is not at its lows for the year, but we're still off nearly 15%, and that's including the bond markets having an awful year as well. It could get worse. I'm not even sure that there's still this question of, will we see stagflation? How will the economy go into recession? How bad could this get? We don't know. Could be a lot worse. However, right now, because the stock market has been kind of chugging lower, your contributions into your 401k is continuing to buy shares at cheaper and cheaper prices. Now, if you're speculating in your investments and just buying an individual stock, or you're buying something incredibly risky that doesn't have a long track record of going in cycles, maybe it doesn't pay off for you. But if you're buying into the S&P 500 index fund that has a history of averaging around 10%, with about a 15% average volatility every single year. So typically the range is you're gonna return between 25% and -5% each year. 2/3 of the time, that's what's gonna happen, okay? And during those cycles, as you're contributing every single paycheck, you're able to buy more shares when prices are lower. You're likely gonna be outperforming than in your 401k compared to your IRA or Roth, because your IRA or Roth, you haven't bought shares at back in March when stocks were at their low point for the year, right? You hadn't, right? But now you have in your 401k. So certainly in down markets or years that start down and then catapult and rebound later in the year, which is typical of midterm seasons, by the way, your 401k, the account that you're contributing more to, typically is going to outperform. So what do you do with that information? Number one, be objective. I would just urge you, don't look at that short-term return, that 3-month return or that 1-year return, and say, well, the ones that have done well, those are good. The ones that have done bad or poorly, those are bad. No, listen, 3 months or 1 year, that's not a cycle. That's not long-term, that is short-term. The investments in the short-term can move like a leaf in a hurricane. You just don't know, okay? So don't overreact if in the short term your 401k is going to outperform your IRA or your Roth IRA. That's sort of how it's supposed to work. Instead, focus in on the investment strategy and the investment tools that you're using within. I've got an individual who has been working, and he's been saving up in his 401k, and he loves how it's performed. His largest holding is the S&P 500 index fund. He doesn't love how his IRAs performed. Where his largest holding is the S&P 500 index fund, right? It's the same stuff. It's just one's getting contributions to it where you're buying at lower prices ongoing versus the other one that's more standstill and is just going to ride with the market. So be objective. Take a look at what your strategies are. Take a look at what your holdings are, and have that determine whether you've got the right investment approach or the wrong one. Second, if you're listening to this saying, well, wait a second, no, mine performed pretty similarly. Well, you might be dollar cost averaging. You might be contributing on an ongoing basis to your Roth IRA. I would recommend that. If you know it fits in your budget and your monthly budget, and you're going to be contributing to your IRA or your Roth, I would try to set that up so you're doing it consistently every month, because I can't predict the 10th of next month if that's going to be a good day to invest, or the 15th of next. I just don't know. I do know on average, from a high point to a low point during the year, the stock market tends to move about 14%. History tells us that. Okay, so as you're contributing each and every month, some of the times it will be up here because the stock market, tends to rise and blah blah blah. But sometimes you're gonna be buying shares down here. So consider dollar cost averaging into your IRA, into your Roth, if it makes sense in your situation. And then the third thing that I would point out here is be aware if you're using different strategies, okay? If you are using a very aggressive strategy within your 401k and you're using just a bond strategy or income strategy in your IRA, you're not going to compare those two together from performance. You're just not going to. It'd be like comparing a golf cart to a Maserati. It doesn't make sense. Those are, yes, they both have four wheels and whatever, but they have different functions, okay? So be aware of having different investment strategies and yet just trying to compare on performance alone. It doesn't work. It will lead you to wrong conclusions and lead you to making mistakes in your overall investment life. So work with your CFP. Make sure, number one, you're taking the right investment approach and risk for your overall financial plan. Our bias is an evidence-based approach, one that's looking at a diversified mix of high-quality, low-cost investments, and then a diversified strategy, a momentum strategy, a hedge-type strategy as well that can adapt and that can add more diversification than just what a diversified portfolio can offer. So that's number one. I'd work with your CFP on that. And then second, like I mentioned, I'd make sure that you're taking the right risk level for your overall financial plan. We don't know. We don't know if this gets worse before it gets better. I don't know if we've seen the bottom yet. We'll see, right? But you've got to make sure that you're taking the right risk level for your retirement plan, your overall financial plan, so you know that you don't have things disproportionate, okay? And then lastly, yeah, the markets have been down this year. If you've got the cash flow, if it fits within your overall retirement plan and your financial plan, consider contributing even more. Even if it gets worse from here, just based on history, that would be temporary. Whether things don't rebound for 2 years, 3 years, or whatever, if you don't need the money over that time frame, if you need it beyond that, these are lower prices that you'll be able to buy at, so consider contributing even more. Work with your certified financial planner on all those ideas. See which one makes sense for you. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.